what's the biggest mistake that you see business owners make when they're going to sell their business?
The number one beyond everything else is everyone gets into the market thinking, I'm going to sell the business and then it's going to be sold. If the buyer can't confidently answer yes, then they may not want to buy the business at any price. The biggest mismatch of all is...
Hey guys, I'm Joe Curry. Welcome to the show. In this episode, which we originally recorded at the end of the year 2023 for our sister show, Your Retirement Planning Simplified, I sit down with David C. Barnett, a seasoned expert in buying and selling small businesses. We delve into the critical aspects of preparing your business for sale, focusing on maximizing value and avoiding common pitfalls. David shares invaluable insights on realistic pricing, the importance of cash flow over revenue, and strategies to reduce owner dependence and customer concentration risks. If you're a business owner considering an exit strategy, this conversation is packed with practical advice to help you enhance your business's appeal to potential buyers and ensure a smooth transition. Also, this is part one in a two-part series. We had a great conversation, and if you find this one valuable, you're definitely going to want to check out part two. Enjoy. Hey, David, welcome to the show. How are you today?
I'm doing great, Joe. Thanks for inviting me on. It's great to be here.
Yeah, we're excited to have you on because, this show is Retirement Planning Simplified, and we talk about a lot of retirement-related things, but I'm pretty passionate also about entrepreneurship and building businesses. And a lot of the people who find us in our financial planning firm are finding us right before or right after an exit from a business. And when we're going to create the best retirement life we can for clients, if they are business owners, we want to make sure they're maximizing the value of their business. And that's where I know you can help out our listeners. Does that sound right?
Yeah, absolutely. This is what I've been in this field. Well, I've been working with small businesses since the 90s, but helping people buy and sell them since about 2008. So I've been in this field for quite a bit. Yeah.
Okay. So you have some experience. That's great. I'm excited for our listeners to kind of hear what you have to say. So today we're going to be talking about, some assumptions and mistakes business owners make when selling a business. And so with that, I think we'll jump right in and just get your take on what's the biggest mistake or maybe the biggest few mistakes that you see business owners make when they're going to sell their business.
Yeah. So the number one beyond everything else is assuming that selling a business is like selling a work of art. And so here's what I mean by that is if you happen to own a Picasso, and you want to list it for sale on Kijiji, for example, you say, I don't know what people might pay for it, but so I'll put the price really high. I can always bring it down later. And when it comes to selling a business, this is a mistake. And here's why. When you're selling a business, what you're selling is a cash flow. And it's a risky cash flow compared to other kinds of cash flows that people can invest in, like government bonds or a basket of stocks from the stock market, a mutual fund, for example. And so when you decide to sell your business, you're going to be entering into a marketplace where there are people that may already be looking for a business like yours. And so those people, the informed buyers, they're the best buyers because they understand the process, they know what they're looking for, and they also know what it's going to take to do a deal. So they probably have some money, they have good credit, they have maybe some experience in the industry that's leading them to look for a business like yours. And they are going to qualify with a banker who's going to help them out with financing potentially. And so this buyer, they understand the industry and they have an idea already of what a business of a certain size with a certain cash flow should be priced at. And so if you enter the market and you're asking for 50 or 80 or 100% more than what your business is really worth, and you might chuckle, but I see it every day, Joe, where businesses are offered for sale for way more than they're worth. That informed, educated buyer is going to look at that and they're going to think that you don't know what you're doing. And they're going to think, if I engage with this person at this moment and I make them a realistic offer, they're going to think I'm lowballing them. And so that wise, capable buyer is not going to engage with you. And what's going to happen instead is you're going to meet people who also don't know what they're doing. And those people could even agree to a full price offer with you. And then they're going to get to the bank and the banker is going to explain to them why the deal doesn't cash flow and they can't afford it. And the deal will fall apart. It just won't close. And so unfortunately, I've met many people over the years who have gone into the market trying to sell their business without any kind of real qualified advice about what the business is really worth. And they spend their time, they talk with these people that they meet, they try to put deals together, and they don't get any traction. And here's the danger, is when you decide that it's time to put your business up for sale, you are being motivated by different criteria. It might be something in your personal life or a desire to retire, for example. When you make the decision that you want to move on to the next thing, you start to disengage mentally with the business. You start to check out. Your foot comes off the gas. There's all kinds of analogies we can use. And when that change happens in the owner, there are trickle-down effects in the business. So the way that you hold your employees to account, or the way that you maybe used to return people's phone calls even into the evening, and you start to back off on some of this activity, which really pushed the limits of what your business was able to do, things start to become more relaxed. Your attitude about the business will start to rub off on employees, and they in turn will start to have an effect on the way customers interact with the business. And this is when I'll typically see a curve downward. And so people become more relaxed, the performance of the business starts to change, and this will have a material impact on the value. When people make the decision, I'm going to sell my business, the moment the decision is made, you now have to act quickly to actually find the buyer, package it up, find the buyer, get your deal done, execute that deal, and leave. You want to do it as quickly as possible to preserve the value that's there. And so that would be the number one thing is the incorrect price, followed up quickly by not having an understanding of realistic terms of sale. Businesses are typically not sold on a cash basis, meaning that when it comes time to sell the business, it is very rare for the buyer. And I'm talking about profitable, established businesses which have any amount of what we call goodwill. Right. It's really rare for a buyer to show up and write a check. In almost every situation, there's some degree of terms of payment, meaning you might get 60, 70, 80% of the money on closing, which could be a combination of the buyer and bank's money. But then you will have to hang on and be paid over time to a certain degree. That's normal. And, right. And this is another case where people get led astray. If they don't understand that this is normal, they can sometimes receive a perfectly good offer and reject it just because they don't know what a good offer looks like.
Right. Right. No, that makes perfect sense. And just kind of hearing you talk about that kind of starting high and how that just leads into this snowball effect on value. I mean, part of the reason that we were just talking before we jumped on here that I recently got my CEPA designation, Certified Exit Planning Advisor. And a big part of why I wanted to do that was because I've had multiple clients come in and some clients I've worked with for a few years before they've gone to sell their business. But, they've told me they're getting ready to sell. They're taking, we're getting this number minimum. I know for sure. So then we start building that into planning. And, 3 years later, they're just like, I just got to get out. I'll take anything. And they're taking, maybe 25% of that original number, which you can imagine what that does to a retirement plan.
Yeah, I can imagine.
Right. So yeah, that's definitely something that I've seen and here just with my clients in general. So I appreciate you sharing some of the details of that and why that happens. So those are a couple of the big mistakes. Now, if someone's getting ready to sell their business, aside from everything you just said, what are one or two things that you wish business owners knew before they started getting ready to sell their business?
Yeah. So look at it from the buyer's point of view, because the business that you own today could be producing a very healthy amount of cash flow for you. And you think, wow, this is a great business. Who wouldn't want to have all of these profits and this paycheck, et cetera? But the business that gets transferred to the buyer is not going to be like your business, because the big difference is going to be that the buyer is going to have this huge debt that they've assumed in order to buy the business. And so it's not going to look or feel the same. The buyer is going to approach your business and they're going to ask themselves two questions. And the first question is going to be, what is the cash flow, right? And the cash flow is going to determine the price. The second question is going to be, is this cash flow going to continue under my stewardship? And to answer that question, you then start to get into a whole range of other topics, like, are there systems in the business clearly documented? Is there any high degree of risk or reliance on a key individual, key supplier, key customer, or the seller's individual talents and training that may be difficult for me to replicate, right? And so all of those other factors get led into that second question. And if the buyer can't confidently answer yes to the second question that the cash flow will carry on under their stewardship, then they may not want to buy the business at any price. Or they may start to bring some of those risk factors into the negotiation. And that's going to show up in one of two different ways. It's either going to be, in order for me to live with this risk, I need a better price. So they're going to use these factors to try to reduce the price. Or I'm ready to pay the price, but these other things scare me. So I need to share the risk with you, which means I need you, Mr. Seller or Mrs. Seller, to finance a higher degree of the business price. So you're going to be getting less on closing day. And the amount that you receive over time could be tied to certain caveats. And I'll give you one quick example. If you have one customer, for example, that is 30% of revenue, right? That's what we call customer concentration. You might be receiving an offer that says, I'm going to pay you for your business. Let's say it's $1 million. I'm going to give you $600,000 on closing day, and I want you to finance $400,000 of this. However, we're going to split that debt into two different parts. We're going to have one $200,000 debt payable with interest maybe over 5 years, and the other one maybe is going to have the same terms, but it's tied to that specific client. So if the revenue from that one client drops below a threshold maybe that we set, I get to stop making payments on the second note. And so that would be an example of how somebody would share the risk back with the seller. So in that example, maybe the price, the buyer agrees that your business is worth $1 million, but the way it's going to be paid out over time is going to be contingent upon the retention of that key account. That's just one example of the kind of stuff we get into.
Yeah, no, it's, I think that's a big thing that people forget about, right? Is the mindset between the seller and the buyer is not the same. And I've been through that process with the business I own now. I mean, I bought this business and I originally came at it as, I think you would say, a strategic buyer, where I kind of had the infrastructure set up that I needed and I could take over that business and incorporate it into what I was already doing. But the business owner wanted that business to keep running, keep the staff, keep the office, everything going. So that kind of changed the cash flow outlook, right? When you're keeping all that in there. So it's the purchasing price to make all that work is completely different than that more strategic buyer who can kind of roll it into current operations. All right. And so what do you think business owners are focusing too much on, and where else should they focus when it comes to increasing value in their company? And I think you're kind of touching on this stuff already, but maybe go a little bit deeper on that. Yeah.
So the biggest mismatch of all is focusing on revenue versus cash flow.
Right.
So, and a lot of business owners, I think, maybe do part of the sales or have a background, or certainly maybe when they started their business, they did sales. And so a lot of, the point of view of a business owner is, well, if I'm going to grow this business, I'm going to sell more. But if you don't sell under the right conditions, if you don't understand precisely what the costs are in the business, you don't have good information, feedback, reporting, you could be growing the top line while not growing the bottom line at all. And so, and there are also several, if you talk to anyone who is a business expert about issues relating to growth, they'll describe certain places in a business's growth where it becomes very difficult to grow the bottom line, where maybe in order to do some more business, you need to add some kind of middle manager position into the business. And then now you've just increased the overhead, right?
Yeah.
And so for it to make sense, we have to get beyond that place to the next sort of tier where we can start to put more of our profits down on the bottom line. And so that's the focus, is got to be bottom line growth. So depending on your horizon from when you expect to want to sell the business, that should inform your decision about how you grow. So if you think you might want to sell in just a couple of years, you may not want to grow into that position where you start to increase your overheads by adding, middle manager type positions. And maybe what that means is to say no to potential new customers and just focus on efficiency to get more of that top line to fall to the bottom. But if you have a 10-year time horizon, it can lead to another whole set of solutions that are going to work for you. Maybe you figure, I do have time to kind of get through that that desert to the next oasis where we're going to start to make more money. So bottom line, the cash flow is what determines the price of the business.
Okay. And so maybe so cash flow, obviously, I mean, you've made that very clear. So hopefully our listeners are getting that. It's not about revenue, it's about cash flow. But beyond cash flow, there's some other things that can enhance the value of a business, right? So, you work, I guess you went at this kind of the opposite way I'm coming at it right now, but there's things like, you said, like customer concentration, there's, owner dependence, there's, I guess it could also be like vendor concentration. So there's other areas too, right? So if someone has the business working well, they have high profit margins, cash flow is good, they know they're going to be selling in the next little while, what are some of those other areas they could be focusing on to drive some additional value to the business?
Yeah. So, I guess I like to put it this way, is that you look at the cash flow, this determines, what the business might be worth. And then there are things that are going to whittle away at that. It's like when you go shopping for a house, a 3-bedroom home in a certain neighborhood, a real estate agent could probably tell us a pretty good idea of what that house might be selling for. When you show up there, though, and you see that the roof is in need of repair, or that the furnace is from the 1980s, these are things then that you realize, well, I'm going to have to take care of that right away. We need to start knocking some of the cost of doing this work off the price. Yeah. Same sort of thing happens in the world of selling a business. People are going to look for the things you just mentioned, these different kinds of risks. But to go back to the house analogy, if you've been thinking of selling and you've been deferring revenue or replacement of equipment because you want to take more money out of the business and you think, well, the next owner can take care of replacing that machine or buying a new truck, a well-informed buyer is going to be examining all that kind of stuff. So if you're not keeping up with the regular maintenance on capital equipment, if you're not regularly replacing, if you own 15 trucks and they're all more than 8 years old, instead of having a healthy mix, a couple of new ones, a couple of mid-aged ones, et cetera, then any buyer is going to look at that and say, I'm going to have to fork out a bunch more money in addition to what I'm paying the seller. Yeah. That's going to also determine the price they're willing to pay. And here's the thing is, like, everyone gets into the market thinking, I'm going to sell the business and then it's going to be sold. How do I put this? A common way that I put it when I'm talking with sellers is I'll say, getting an offer on your business that's a good offer is like winning the lottery. Closing the deal and getting paid is like winning the lottery again the following month, right? You're talking about two really difficult things. And let me highlight this. There's been different studies done about the success rate of people putting businesses up for sale. And there are some statistics out there that say as many as 4 out of 5 businesses that get listed on these big business for sale websites do not sell.
Yeah.
Right. And so you want to have a great business, you want to position it for success, but even if you find a buyer right away who makes you an offer, it may not close. And so you need to operate the business under the assumption that it will not sell. You need to keep your eye on the ball, manage the business, focus on it as though it were not being sold, because the backup plan for anyone out there who wants to retire, who's a business owner, is that if you can't sell it, you just have to run it for a few more years to take more out of it. And that's how you're going to make up this gap, right? And so you don't want the business to slide or lose profitability, lose cash flow, if you may have to rely on that plan B.
Yeah, and the interesting thing, I think, is when people go through the planning and they start doing these things like, policies and procedures and getting the right team in place, and it makes it easier for them to run the business, and they can become more profitable. And now the business is worth more. But I think in some cases, and you probably know this better than I would, but I think I've seen it though, where now the business owners are saying, well, you know what, this is actually kind of nice the way things are running right now. I don't know if I want to sell anymore. Right.
It happens. And, if you can get processes in place where you can better delegate and then have systems of information to know that the delegated things are being done correctly and the customers are being served and everything. The most lucrative exit from a business is not a change of ownership. It's just you going out the door, right? Like, okay, I've exited now. I don't come here every day, but I still own it. And you think about that for a minute. More and more, I'm meeting business owners who, because of technology that exists today, can go to Florida for the winter and continue to own and manage their business through their computer and telephone and all that kind of stuff. And it's really, again, it comes back to personal motivations. Yeah. It's either you are unwilling to do that, you are unable to do that, or some other reason, physical, issue, like, you're ill or something like that,
sure,
where you need to sell. If you can pull it off, that's the most lucrative exit. Yeah.
Absolutely. All right. So I think we'll end it there. A couple of things. We're going to have David back on for another episode because we want to talk some more things about exiting from the business. Also, though, before we do that, David is a wealth of knowledge. So can you share with our listeners, David, where can they find you? How can you help? What do you have going on?
Yeah, absolutely. So thanks, Joe. I have a blog site, davidcbarnett.com. It's where I post all of the content that I create. There's information there, videos, etc. And speaking of videos, I've got a YouTube channel with over 600 videos, all about buying, selling, financing, and managing small and medium-sized business. All that content's for free, and the audio is put onto a podcast feed too. So if you go to my blog site, or if you just go to YouTube or your podcast app and just put in David Barnett Small Business, you'll find me.
Perfect. Well, thanks for joining us today, David. I'm sure our listeners got a lot out of this, and I'm excited to have you back on again soon.
Awesome. Thanks for having me. This has been a lot of fun.
All right.